Hey everybody, Ben Hart here. It is December 11th at 1 p.m. And we thank you for joining us for the Hart Investment Group weekly roundup. Going to cover a number of things today. Going to talk about interest rates. Yesterday, certainly the Bank of Canada and the FOMC had meetings, so we'll discuss that. Some earnings numbers as well. We had Oracle release some earnings today. And a quick comment on the gold and gold company market. So lots to cover. Thanks so much for joining me today. I am flying solo today, so I'm going to just give you a quick update on a few things before we jump into the slides of the day. So yesterday it was much announced. So we were waiting to see what the central banks of North America did, or at least Canada, US. And leading into the event, we had a very low probability of Bank of Canada making any changes, and they did hold firm to that. They did not cut rates. And some of that, and I'd say a big chunk of that, is on the back of the employment number that came out the week before. And we had a jobs beat in Canada, but job data in Canada has historically been extremely choppy. And I think it's important to look below the surface as well, because the majority of those jobs were part-time. I'd say almost all of them were part-time. There's no job increases in full-time. In fact, there's a slight net negative on the full-time basis. So quality jobs number is pretty weak. So I think that really put the Bank of Canada in a bit of position to say, what do we want to do at this point? And they chose to hold firm with the view of we'll continue to pay attention to what's going on in the jobs data and in the inflation GDP numbers because they're still concerned about that. So my view was it was a soft hold with the view of maybe we see something happen again in our January or March meeting. Most likely we'll have a better picture for what things look like in March. There was some inflationary pressure, we'll say 12 months ago or 14 months ago. So the inflation numbers start to get easier February, March, April of next year. So that can play a part in what the Bank of Canada does. So right now, that's what we see. And what does this mean, I guess, for the rest of the bond curve in Canada? So historically, at least, when the bank decides to stop cutting rates, and so they control the front end, so they control variable rate mortgages, they control money market funds, high savings, and effectively control the front end of the curve from a rate perspective, where the market tends to control the longer end of the curve. So historically, when they go on hold, you see over the next 12 to 18 months, you see a flattening of the curve. And so you'd see the 5 and 10 year historically moved down 30 to 50 basis points over that period. So it's relevant from an asset allocation perspective, and that's something that we pay attention to and are concerned about when we're making decisions for what is in the portfolio. Then if we look over to the US side, what happened there? So we had the FOMC, so Federal Open Market Committee meet yesterday to talk about rates, and that's Powell, who would talk about what's going on. And they chose to proceed with rate cuts with the view of further rate cuts to come next year. And so that, again, that's a combination of things. The jobs numbers in the US have been okay in the most recent, but what's happening in the jobs numbers in the US, have you seen participation rate fall? So that's not great when you're looking at the health and quality of those job numbers. And if you listen to Chair Powell's meeting yesterday, he did seem to refer to that multiple times, seeing if you looked at the most quarterly reporting numbers, number of firms laying off people, high quality jobs, full-time jobs. And so the one thing that the US does is that if there's two jobs, if it's a single person that has two or three jobs, that counts as three jobs. And so I think if you look at and listen to what he said, they have still concerns about the job market in the US, so they'll continue with a bias towards cutting. Additionally, which they commented on, at least they did in their last meeting, and then they provide an update on in this most recent meeting is quantitative easing. So as of December 1st, they stopped quantitative tightening. So they have bonds on their balance sheet, and those bonds in quantitative tightening periods, they let them roll off and mature in cash. But now what they've done is gone back to quantitative easing. So what they're doing is anything that matures, they roll out further. So their balance sheet will start to expand as a result of that. So what that does is increases liquidity, but we're just in the early phases of that. I heard someone describe this as QE light. So we'll continue to watch and see what happens from that perspective. But the bias is towards still, again, lower variable rates in the US. So we would track that as well. And the last piece before I jump into the slides is just on Oracle. Oracle's release today. Oracle came out with their earnings, and they earned 16.06 billion for the quarter instead of 16.26 billion. So market was disappointed with their results. Stocks down about 10, 12, 13% here as we record. So that's dragging down NASDAQ. If you look at the rest of the markets, Dow's up a little bit here, and TSX is also up in this backdrop. Gold companies are running. We'll comment on that as we go. So let's jump into the slides. All right, so as I mentioned off the top, this is December 11th, around 1 p.m. Thursday. We are recording this. If anything happens between now and next Thursday, we'll certainly comment on that then. But thanks so much for joining me today. And this is one of the key things I like to look at. So we're going to start off here with speculative positioning, non-commercial CFTC. So this is speculative positioning, and I'd like to look at this just to see where the outliers are something maybe on the other end where everyone knows with certainty that things are going to continue to go up. So that's in an overbought category. And are people anticipating something's going to continue to go down forever? And that's in the, we'll say, the oversold category. And so this is speculative positioning across pretty much every major asset class. So equities, rates, FX, and commodities. And so as I look down at this chart, I look and see where what we've seen most of this year is you've had a pretty heavy short position on the bond market in the US. So this is one of the more hated trades out there. And so given where we are in the market environment, that makes me think, okay, if everyone hates the bond market, maybe there's some potential alpha or some potential reason to own that in your portfolio. But one thing I will note is that the longer end of this curve has really gone to a flat positioning. So no speculating long or short at this point. You see most of it on the front end, heavily weighted in the 5 to 10 year right now. So a number of speculators are betting on yields continuing to go up and bond prices down in the US. And so that's interesting for me. It gives me a little bit of comfort actually having some exposure in that category, because if we get a shock, maybe something happens to equity markets, bonds typically rally, at least in this part of the curve immediately. And that could be a reason to have some exposure to that space. Then if we look up into the equity exposure here, so you'd be looking at NASDAQ, again, tilted towards nothing can go wrong. NASDAQ keeps going higher, so that's a bit of a warning flag that we need to be conscious of. And then as we zip down, I'll just comment on the last one here at the bottom, which would be commodities. And we look on the commodity side of things, quite positive positioning still on gold. And then if we look further down the scale here, you get negative on ag and you get negative on oil. So that's interesting, particularly with oil at the bottom end of the range right now. And with the view, at least my view, is that I think commodities can do quite well for a number of years. So just as you're thinking about positioning, this is one of the inputs that we take into account when we're thinking about whether we want to have exposure there or not. The other piece that I like a lot, this is from our Chief Investment Office team as well, just around sentiment. And so sentiment, I think, is a huge driver and is something that plays a major part. So again, if you'd asked me this when I started in this business 20 years ago, I wouldn't have said sentiment was a big driver. But sentiment now, just based on how markets react, how quickly information gets disseminated into the markets, this really is a driver for how quickly the markets can move in one way, shape, or form. So these are the multiple scenarios. So you get momentum, volatility, breadth. So momentum obviously is how much momentum in the market. Volatility is how much things fluctuate. Breadth is how wide, like how many stocks are going up in that backdrop. What's the risk appetite? What's the speculative appetite? And then what are the surveys saying at this point? And so we've been hovering around here. So the box is last week and the current line is this week. And so if you look at last week, volatility is way down in this risky category. We've had a market rally, so volatility going down results in a positive swing on the curve in this one. And so we've been sitting around this 30 to 40 sentiment gauge now for, I feel like 6, 7 weeks. And so that gives me a bit of confidence that markets probably migrate higher at this uncertain period. If we're at extreme pessimism, that's probably a bottoming. Extreme optimism, that's probably topping. But if we're sitting around the lower band of middle, that tends to be quite a positive signal for what could happen in the markets going forward. So this is sentiments pointing towards a greenish tinge on what can happen from this point. This one is Fed funds rate versus Bank of Canada rate. And so often, I get questions about Canada versus US dollar. Lots of people want to talk about that. That plays a major part from how I construct portfolios because there's a lot of stocks I like in the US market, a lot of stocks I like on the Canadian market, and those can play a part into why you should have exposure there. Of course, we always have people that travel to the US as well, particularly Florida this time of year. And so this conversation comes in, what's likely to happen between the Canadian dollar and the US dollar. So this number narrowed yesterday because we started the day at 4 and 2.27, or sorry, 2.25, and that moved down to 3.75 to 2.25 because the Bank of Canada didn't move. And so we're 1.5% spread between these two. Interesting. If we came into this year, there was some talk about, what's going to happen if this spread gets more than one. In the past, when we've gotten wider than one, we tended to have a bit of a crisis to our currency. But this year, what's transpired, it's a different event because we had many changes south of the border with tariffs and trade and deficits, a number of things that caused the opposite to happen, which is the Canadian dollar was a relative stronger performer to the US, even though the spread's this wide. So at this point, I think that the variables that'll impact the Canada US dollar are not necessarily going to be the spread at this point. It's going to be a number of other things. So certainly what happens to our two economies relative to each other, what happens to the price of oil as that is started, Canadian dollar has started to track that more closely at this point. Now that it looks like most of the tariff narrative's been digested. So pretty wide number we're looking at right now. And I think it's important to think about just when you're looking at portfolio construction. But if you are traveling, the Canadian dollar's done quite well relative to the US, and I don't think that continues for a very long period of time. Next one, what happens to bonds when interest rates change? So 1 year total return from a change in interest rates. Again, I've pulled up this slide many times, and for those who watch frequently, maybe are sick of seeing this. But what happens if we get a movement in interest rates either up or either down? And as I noted off the top, if the Bank of Canada has gone on hold, historically, you get a flattening of the curve when that happens over the next 12 to 18 months. And so in a hypothetical sense, if you get the 10-year Government of Canada bond go down 0.5% and head towards this way, so you're looking around this level, if you actually own the Government of Canada 10-year bond, you get about a 7% positive return in that backdrop if we get this. So when I'm thinking about portfolio construction, I think what is likely to happen going forward based on the numbers we see today, based on the historical data that's telling us what's likely to happen. And this is a great chart thinking about construction. If you want to have a little bit longer duration, say you want to have, like, say the US got into an economic slowdown, what typically happens in that end is you get an extreme flattening of the curve. And if you owned a little bit of bonds out here, and we'll say interest rates on the 30-year went down 1%. And so if you get a 4 to a 3% move on the long end of the curve, that results in about a 21% capital appreciation in your bond portfolio. And so, why you do this is you may want to have some bookends. You may want to have some things in the portfolio that can go up when other things are going down. So if you get a correction in tech, maybe you get a rally in your bond portfolio. So it's just important just to think about portfolio construction. And this chart, I think, tends to lay it out pretty good. And then if you're looking on the corporate side, if we do nothing, say you got 100%, or sorry, on say you got a 1% move lower in corporate bonds, that's a 10% capital appreciation. But if you get the opposite, which is a 1% loss in corporate bonds, you only get it's only a 1% downside. So pretty good risk reward in a number of these categories. And I think it's important when I'm thinking about portfolio composition. Last chart here on US stocks trading in Canada that are down year to date. So I know I've given a couple of weeks now. We've been talking about tax losses. What should we do? How should we do it? What, should we be in this or that, the other thing? There's lots of different ways to look at things. This is a great way to just look at a number of stocks that are trading down that you can buy in the Canadian market. So CIBC has these CDRs. CDRs are Canadian depository receipts, similar to ADRs that trade in the US, but these ones trade in Canadian dollars. So if you're looking at, for example, if you're looking for a tax switch in something in Canada, maybe like a stock that has, or you hold a stock that hasn't done very well in Canada, but you like a US stock, in the example of maybe Adobe, United Health, that Warren Buffett has recently announced that he's participating in, their Salesforce. When I look across here, let's look at Salesforce, for example, that trades in the Canadian market. It's down year to date, 23%. It has bounced a little bit off the lows, up 18% off the lows, but maybe that makes sense as a tax switch within the portfolio. Again, another place you may want to look at, maybe that hasn't bounced as much off the lows. Look at a company like PayPal. PayPal's down 30% year to date in Canadian dollar terms. It's only about 7% off the lows. So again, if you're looking at making some tax switches, it makes sense to say, what are my options available to me? How and where should I get exposure? Again, if you like United Healthcare as well, still down 37% year to date. It has bounced off of the lows, but that's something that you may want to consider within your portfolio if you're looking to reduce some of the capital gains that you've made this year and switch into companies that you think have some pretty good upside based on your views and such. As always, everyone's risk tolerance is different. But this is some of the things that I do as we get into December tax loss selling season. This is a great chart just on the US stocks that are trading on the TSX. As always, everyone's opinions, oh, sorry, the opinions expressed do not necessarily reflect those of National Bank Financial. Everyone's risk tolerance is different. If you have any questions, you want to discuss investments, these particular ones or anything, please feel free to reach out to Eva or myself. We're happy to discuss and or address them at that point. As always, I appreciate you looking and listening to the charts of the day today. Okay, so finally, just going to wrap up, give you a little comments on what we think is going to happen next week. Number of things going on still as we march towards Christmas. We are 14 days away, 2 weeks today. 2 weeks today. So one more wrap up prior to year end, which will be next week. And then the following Thursday will be Christmas Day, so we won't be recording that day. But next week we have Canadian jobs update, non-farm payrolls coming out. See what else we got. Some U.S. data as well. But generally a little bit quieter next week from an information perspective. Now that we've seen both the Bank of Canada and the FOMC release their results, so a little bit less data. U.S. is still catching up though because of the government shutdown, so we're still seeing that flow through to the markets, and so we'll watch that then. And we'll see if there's any more company data to come out. But I'd say generally pretty quiet as we head into to the end of the year. I continue to do tax loss adjustments, changes within portfolios. We've reached out to accountants, getting any capital loss carry forward information. If there is anything you want to discuss with us, please feel free to reach out to Eva or myself. Happy to have a quick discussion either with yourself or your accountant as we make changes into the end of the tax season here. So as always, thank you for joining me. Hope everyone has a great weekend, stays warm as it's cold out there if you're in Ottawa, and we'll see you again next week. Thanks, everybody. Take care.